Hello everyone, welcome to TaxExterminator.com, where we kill taxes dead. You're going to learn how to reduce your taxes legally, beginning today. I'm your host, Brent Jordan, veteran tax attorney, former UCLA adjunct professor, and current district court trial judge. Today's webinar is entitled The 12 Biggest Tax Mistakes That Cost Business Owners Thousands of Dollars Each Year. The legal authority for this webinar is the United States Tax Code, the U.S. Treasury Regulations, U.S. Tax Court, IRS Revenue Procedures, Private Letter Rulings, Publications, the Manual, and Tax Forms. Today's segment is entitled Failing to Plan. But before we get started, a little bit of humor. Here's two people on a deserted island. One finds a bottle, drifts ashore, opens it up, there's a little piece of paper, and he says, "Oh great, we got our 1040 estimated tax coupons." We begin with a very famous holding by the Second Circuit Court of Appeals in 1934. The court held, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the United States Treasury. There's not even a patriotic duty to increase one's taxes." Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for nobody owes any public duty to pay more than the law demands. Here we have Chief Justice William Rehnquist of the United States Supreme Court. May God rest his soul. He once said, "There's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that." Well, the first thing I'd like to look at in failing to plan is the actual tax return, which to some people is mind-boggling. So I'm going to do my best to look at it, to explain it in very simple terms. First, you consider your total income. What is income? It's your earned income, interest and dividends, capital gains from stocks, securities, and real estate, your pension, IRA, and annuities, rents and royalties, spousal support, gambling winnings, and if you can believe it, the IRS even requires you to report illegal income. From your total income, you subtract adjustments to get to your adjusted gross income. Adjustments include 1/2 of a business owner's self-employment taxes, your retirement contributions, health insurance payments, educational expenses, and for those people unfortunate enough to pay this, spousal support. Then you subtract your deductions and exemptions to arrive at taxable income. Deductions and exemptions include business expenses, taxes, interest, medical and dental payments, casualty losses, charitable contributions and gifts, and miscellaneous deductions and exemptions. From there, you find your tax liability. Now I'm showing you the 2014 tax brackets. Very interesting to say the least. You'll notice the bottom rate is 10% and it progresses up all the way to 39.6%. Now doesn't that sound like a used car salesman? I'll sell you this car for $39,999. Isn't that essentially what Congress is doing? Rather than round it off at 40%, they figured it'd probably sound better to the American taxpayer when they said 39.6%. In any event, notice the level where you pay zero taxes. For a single person, that would be less than $9,075. And for a married couple filing jointly, less than $18,150. Then what's also interesting is the upper brackets. Look at the 33%, 35%, and 39.6% brackets. For a single person, when he or she begins to earn $405,100, all income is taxed at 33%. But it only takes an additional $1,000, that is $406,750, to get to the 35% bracket. And then anything over that amount is taxed at 39.6%. As you'll notice, you can make and earn more money as a married couple filing jointly and be in a less tax bracket than a single person. So once you determine your tax liability, then you subtract credits. And credits have to do with your family, with renovations, education, business, foreign taxes, and low-income housing. And from there, you calculate your total tax payment. When I ask most people, do you have a proactive tax plan? They look at me, shrug their shoulders, scratch their head and say, no, should I? Well, there's one important fact. If you don't have a tax plan, you still have a plan. You've simply planned to pay Uncle Sam more than your fair share of taxes. So what I'm going to do right now is provide you a tax reduction strategy plan. I call it the Holy Tax Grail. Any tax reduction strategy plan is comprised of these 7 items in 3 groups. The first group involves income: tax-free income, tax-reduced income, and tax-deferred income. In other words, what you want to do is transfer ordinary income into tax-free income, or tax-reduced income, or tax-deferred income. The second group has to do with expenses. They involve adjustments, deductions, exemptions, and credits. We've already talked about many of those. And the final group has to do with tax shifting. Shifting taxes to future tax years, shifting taxes from higher tax bracket individuals to lower tax bracket individuals, and shifting deductions from the future year to the present year. Ronald Reagan once said, "We don't have $1 trillion debt because we haven't taxed enough. We have $1 trillion debt because we spend too much." Well, that completes segment 1, Failing to Plan, of our webinar entitled The 12 Biggest Tax Mistakes That Cost Business Owners Thousands of Dollars Each Year. There's a treasure chest of free money buried in your business. Claim it today. Thank you for coming. This webinar was brought to you by TaxExterminator.com, where we kill taxes dead. home of the proactive tax plan. Thanks for joining us, and I look forward to seeing you for segment number 2, Wrong Business Entities.